Good evening, everyone, and thank you for taking the time to listen to me today. And also thank you to the two earlier speakers. So it's very interesting for me to hear about market parts of the market that I don't really think about in my day job. What we'll be talking about here today are infrastructure assets, so real assets, illiquid, generally pretty hard for retail investors to get exposure to, unless it's through a fund such as JLEN or other peer funds. And time has shown that investment trusts are a pretty good structure to hold these kinds of illiquid assets. So I'm Chris Tanner, and I've been a partner within Foresight Group's infrastructure division since 2019. My involvement, though, goes back beyond Foresight becoming the investment manager. I led the original IPO of JLEN in 2014 as part of the first generation of income-focused renewables investment trusts to come to the market. So this has really been my focus for the last 10 years. A bit more detail on Foresight Group. So we are a sustainability-led alternative assets investment manager. We have over 12 billion in assets under management, and the large majority of those assets sit in the infrastructure part of the business where my team and I are based. So there are lots of benefits for JLEN from being managed by a broad alternative investment manager like Foresight. I'd just like to highlight the origination and execution capacity of the Foresight team. So we see over 600 opportunities a year within infrastructure, and for the most part these all have some sustainability angle to them. So we have the breadth and depth of resource that means we're able to get across all of these different sectors for JLEN and to focus only on those that we think are the best fit for the objectives of the fund, and some of those I'll talk about today. So JLEN is a diversified environmental infrastructure fund. It has a broad mandate that has to date taken in 10 different technology types, some of which generate renewable energy and some that do not, but have other environmental benefits. And that's one of the things I'd like to stress. It is an environmental infrastructure fund. It is not just a renewable energy fund. And the reason for that is we feel it's clear that infrastructure assets like ours need to become part of everyday life if societies are to live sustainably. We target a sustainable and progressive dividend, and we've been able to deliver that every year since IPO. At the current share price, the dividend for the year gives a cash yield of about 6%, and we've delivered an annualized total shareholder return of over 8%. So steady income and some capital growth from investment in the sector. Our portfolio has a high level of inflation linkage. When we look at the underlying revenue sources of the asset base, 60% of those revenues on a discounted basis are linked to RPI. And we also put considerable effort into working out how to communicate the portfolio's ESG credentials, something that we've been recognized for with recent awards. We hold ourselves up to a high standard in terms of processes and in terms of the impact that our portfolio assets have on the environment. So our investment strategy is to target infrastructure assets and businesses with infrastructure characteristics that support more environmentally friendly approaches to economic activity, that support the transition to a low carbon economy, or that mitigate the effects of climate change. So far, that strategy has taken us into renewable energy technologies, including a range of intermittent and baseload generators. It has also taken us into wider environmental infra assets, such as waste processing, low carbon transport, battery storage, most recently controlled environment, agriculture and aquaculture projects. We're also seeing increased opportunities in the byproducts or waste outputs from our projects. So for example, our Cramlington biomass power plant, where I was earlier on today in Newcastle, is able to sell otherwise waste heat to nearby businesses. Our recent investment into a controlled environment glasshouse is located next to one of our anaerobic digestion power plants. And because of the synergies that exist between the two, we're able to transfer, again, waste heat and renewable electricity to that glasshouse. Our biocollectors food waste business powers its own collection trucks with biomethane that it's produced from food waste. So these are all illustrative of the way in which societies will need to think about resources in the future and to manage them as efficiently as possible in order to thrive sustainably. Our investment policy, the purpose of JLEN really is to facilitate following these trends where good investment opportunities emerge. So the next slide just gives some performance information over the last few years, although of course past performance is no guarantee of the future. I'll just pick out dividends. We are primarily an income-paying fund, and we've paid a growing and fully covered dividend to shareholders for each of the last 9 years. I'll also note that our year end is 31st of March, and that we're due to announce our net asset value for 31st of March 2023 shortly, along with the dividend target for the year ahead. So watch this space. So we make a number of contributions to environmental measures, as you can see on this slide, such as renewable energy generated, waste diverted from landfill, wastewater treated, and so forth. So we've adopted and actively promoted ESG since the launch of the fund. We produced our first ESG report in 2019, and we continue to make progress in this area with a dedicated ESG committee of the board that oversees the work done here. We've also made recommended disclosures under the recommendations of the Task Force on Climate-Related Financial Disclosures. So we try to identify the climate-related risks and opportunities that we face, and we also follow the UN Sustainable Development Goals. So hopefully you're getting the feeling that we work hard on communicating our approach to ESG, and we're very pleased to have been recognised for that, winning the Association of Investment Companies award for best communication of ESG, as well as some other commendations from industry partners. Next slide, please. So this slide shows where our assets are. It's a UK-focused portfolio at the moment. So as at the 30th of September, 92% of the portfolio by value was located in the UK. We do have some European assets, including an energy from waste plant in Italy, a land-based aquaculture facility growing trout in Norway, and interest in wind and solar assets in Scandinavia and Spain, respectively. Foresight has overseas offices in a number of key markets, and so I think it's likely that we will see further growth in overseas investments. But having said that, the portfolio will remain UK focused for the foreseeable future. It's also very substantially a portfolio of operating assets, so they are doing what they're supposed to do. They're generating cash yield. We are able to invest in construction stage assets up to 25% of NAV, but as at the 30th of September, only 5% of the portfolio was classed as being in construction. So since then, we've added some further construction assets where we feel comfortable with the risk, and also a very interesting developer play in green hydrogen in Germany, which we think is going to be a very interesting area. So these typically offer higher returns and should therefore also deliver capital growth as they come out of construction and enter operations. Next slide, please. This slide also just gives a view of the way the portfolio is built up over time, both in terms of size and also increased diversification. Next slide, please. So slide 10 shows how we expect the revenue mix of the existing portfolio to change over time, and it also talks to inflation linkage. So if we consider the underlying revenues earned by our assets, we can see that the largest proportion of revenue is categorized as subsidy revenue. So these are typically the subsidies earned by our renewables assets. So they're fixed price in nature, and they have a full linkage to RPI. We also have some projects that are concession based. They enjoy long-term contracts with public sector clients, and there again our revenue streams are typically linked to RPI. So if we link those two together, subsidy and long-term contracts, you can see that on a discounted basis, that comes to about 60%. So that is a high proportion of RPI linkage, and basically supports, at times of high inflation, generally the portfolio increases. Other revenues are typically shorter term arrangements that don't feature the same explicit linkage to inflation, but where we can increase the price over time as we renew those contracts, and that's generally what we've been seeing in some of our other infra businesses. And then the remainder of our revenues come from wholesale power sales, so electricity and also green gas, and in been again a very strong area of revenue growth. Next slide, please. So next 3 slides just give an overview of some of the assets within the portfolio. So we'll start with a wind farm. So that's the predominant renewable technology in the UK. So a wind farm captures the kinetic energy present in the wind resource and converts it into electrical energy. We describe that wind resource as being intermittent. It's not available to generate electricity all the time. The wind farm is typically connected to the electricity grid, and the electricity exported is metered. So that metered electricity in kilowatt hours is sold to an electricity supplier via a contract, a power purchase agreement, or PPA. It's also the metering that determines the subsidy that we receive as well. So that power purchase agreement requires the supplier to purchase the generator's electricity at an agreed price. So this could be a fixed price. We have a number of fixed price arrangements within the portfolio, but it's more usually a price that floats according to a specified price index. And the PPA will also typically govern the transfer of the green subsidy benefits. In the case of most of our wind farms, they are renewable obligation certificates. So we transfer the certificates and the supplier pays us for those. The electricity supplier then on-supplies the electricity to consumers. What we've found recently is that interest from both consumers and corporates in being able to say that they use green electricity has opened up additional revenue areas for renewables assets, as we're able to sell guarantee of origin certificates as well, and green gas certificates. So that's a nice little boost to earnings. Okay, so if we move on to the next slide. So that was wind. Now we're talking about a food waste plant using anaerobic digestion to convert food waste into either biomethane, sometimes known as green gas, or electricity. So food waste is brought to the plant. Often it will be pre-treated to make for a more homogeneous material going into the plant. And this feedstock, as we call it, is then broken down by bacteria in the digestion plant in order to produce a biogas that is rich in methane. What then is determined by whether the plant is a gas to electric plant or a gas to grid plant. In the first case, the gas is combusted in a gas engine and electricity generated and exported to the electricity grid. We do have some of those, but we actually have more gas to grid plants within the portfolio. So this is where the biogas is passed through an upgrading unit where it's brought up to the standard that is sufficient for the GB gas network. At this point, the molecules are practically indistinguishable from fossil natural gas, and it mixes in with the gas network and is used for the full range of applications that natural gas would be used for. So about 1% of gas volumes in GB are biomethane from anaerobic digestion. So just a note on the subsidies for AD plants. So for gas to electric, the subsidy is a feed-in tariff. For gas to grid plants, the subsidy is the renewable heat incentive. So the RHI is very similar to the ROC regime and also feed-in tariffs in terms of subsidy structure. It lasts for 20 years and it has the same direct RPI linkage. The interesting thing for us is the proportion of subsidy to merchant gas revenue. So bottom right of the slide here, you see a gas to grid plant. About 75 to 80% of revenues typically come from the subsidy. So that is fixed price and linked to RPI. So when you consider that we typically see higher overall returns from this technology compared to wind and solar, given that there is also a higher inflation linkage, it becomes quite interesting for us. Next slide, please. And the final case study is for our investment into refueling stations for gas-powered compressed natural gas heavy goods vehicles. So our stations provide a biomethane product, so gas that comes ultimately from AD plants such as our own. And by using this green gas, you get a significant emissions saving compared to the diesel truck equivalent. So it's about 85% lower emissions on a well-to-wheel basis. We provide refueling services to major customers like Amazon, Waitrose and Royal Mail. The attraction for them is on the one hand the fact that they're able to point to what they're doing to try and reduce their emissions, but there is also generally a saving as well, in part due to fuel duty breaks from using a renewable fuel. When they refuel, we bill them for the gas that they use. That is a pass-through of the commodity gas price and also a compression margin that reflects our costs of providing biomethane in a CNG form. So crucially, we're not exposed to natural gas prices. That's passed through. So this is an example of an asset in the portfolio where we have an operating partner that also has a financial interest in the business. And where we have these deals, we structure them in such a way that our base case returns are received in priority until a hurdle is met, and then sharing of upsides occur. So hopefully that gives you a broad feel of some of the assets within the portfolio. Good, skip to the next slide, please. So this covers some of our construction assets. So as I said, a relatively small proportion of the portfolio at the moment in construction, but that grows over time as we inject more money into those projects. Also very interesting to us as it should provide a source of capital growth if we manage construction properly. As the assets enter operations, they de-risk and they become more valuable. So in this part of the portfolio, we have 4 grid-scale batteries, with the most advanced now connected to the grid and just going through commissioning. And we also have 2 controlled environment facilities. So one, a land-based recirculating aquaculture system in Norway, and the second one, the co-located glasshouse that I mentioned earlier that takes electricity and heat from an AD plant that's next to it. So we like, so if we could skip to the next slide, please. So here we're just looking at our near-term pipeline across the features that we look for in environmental infrastructure. From our experience in the Norwegian aquaculture facility, we see that this technology can play an important part in mitigating the effects of climate change through managing water stress. And we think that the market knowledge that we've built up here will place us well for further investments in this sector, alongside other controlled environment assets such as vertical farms that help manage land use change. Bioenergy, such as the AD plants and the biomass facilities, remain a key part of our pipeline. We feel that there is greater consolidation to come, particularly in the market for biogas. We've recently seen some high-profile players publicly state their ambitions for getting into biomethane. We're also trying to think about how we can make the assets that we hold here more resilient, and that may be through acquiring companies that supply the feedstocks, so effectively trying to move up into the supply chain. Battery storage remains of interest to us, although we note that this market is becoming increasingly competitive. One of the advantages of the JLEN mandate is that we can move from technology to technology depending on where we see relative returns. I've mentioned hydrogen as well. We are very interested in this sector. So there's a lot of noises coming from many major governments about the level of support that will come from government to stimulate this sector. So we see this as an attractive part of the portfolio going forward. And then lastly, low carbon forms of transport. So we're already invested in CNG refueling networks. With our hydrogen interest, we may also become involved in hydrogen for transport. And we continue to look at EV charging infrastructure, although we're very cognizant of finding the right model for us. So it needs to be something where we have the infrastructure characteristics that we like of stable, highly visible cash flows, and ideally some inflation linkage. So overall, the pipeline is healthy, and it follows our theme of diversification through disciplined assessments of investing in infrastructure assets that support a more sustainable economy. Okay, and if we can move on just to the last slide. So in summary, JLEN is a broad environmental infrastructure fund, and our mandate is differentiated within the sector in that it allows us to construct a portfolio that is more diversified and where we can assess a wider opportunity set. We have good income characteristics and attractive inflation linkage. We offer a yield of about 6% paid quarterly and prospects for capital growth on top of that. And we have strong ESG credentials, and we work hard to communicate what we do in this area to investors. And it's pleasing to see that this is recognised.